This is Jordan. This video is being recorded on the afternoon of Tuesday, November 14th, 2023. Thank you so much for tuning in. In this video, I'm going to talk about secular trends and looking at the history of secular trends and kind of this domino impact of what happens after you get the start of a secular bear market in bonds, and then what happens after that to the other asset classes. So getting right into it, in this chart we have, which I calculated with the help of someone else, the total return in bonds. So this is calculated from the 10-year Treasury bond. Then we have the S&P 500 here. These lines are monthly data, by the way. Gold, then the U.S. dollar index here at the bottom. These red arrows mark where you could potentially say that this was the start of the secular bear in bonds, this secular bear in the stock market, secular bear in the stock market again. And then clearly here, based on this, a new secular bear market in bonds has begun. And we could say confirmation, breaking below this 80-month moving average, which, I do have data going back here to 1920. And we could basically say, this was the point when the market really lost that moving average. And by the way, I'm going to talk about the 10-year yield and what happened around 68, 69. It broke out. It surpassed the 1920 peak. So that was an important marker. But then it fell below the moving average, and the total returned it. And then we can see that happening here. So even though we get into a recession next year and bonds could have a nice rally, it's going to be a lower high. I mean, that's what the probability favors. It's extremely unlikely that we're going to see a new high here. So even though we're setting up for a counter trend move in bonds, I mean, this is a new secular bear market. And by the way, we did have a counter trend move here in bonds, after this crack here. But the point I always like to make is this is where you had the break in bonds, secular bear market started, and that led to the S&P 500 at the tail end of 1968, just before 1969. That's when that secular bear started. So the crack or break in bonds led to the same in the stock market. Now, the dollar index did not start trading, I think, until 1919, I don't want to say 72 or 73. So this is all recalculated here, a reconstructed dollar index. So we can't really, use that for this domino study. But nevertheless, I mentioned the domino impact because here we had the S&P, March of 2000, tech bubble burst. That's the end of the secular bull. But the dollar did not peak until almost, this is weekly data. This is almost, at the very, very end of 2001. So the dollar did not lose this secular bull until almost 2 years. 1.75 years after the stock market. So what we could be setting up for this time around, and again, this, where we're at here with bonds cracking, and, we've made all the other comparisons to the mid to late 1960s. So we're seeing this again, and this is already cracked. And so at some point, we're going to get the stock market going into a secular bear. And I think the dollar, maybe that doesn't peak and roll over in secular terms until after the stock market. So again, bonds are cracking, stock market's probably next, then you get the dollar after that. And remember, gold and precious metals, they do lead the dollar. So it is important that the dollar eventually goes into a secular bear. But, for here and now, maybe we get this gold breakout before the dollar cracks. But we probably do need to see the stock market slipping and cracking for gold to make that breakout, even though gold is getting really, really close. So that's where we are in the big picture. I mean, the most important recent development, clearly we're in a new secular bear here in the bond market, and that is going to feed into a secular bear for the S&P 500. Because as you know, many people have said, Vince Lancy pointed this out, Luis Yamato, the legendary technician, once you saw in this point the 10-year bond the yield got up to 5.5%, that's when it really broke the market. And so we know that that's if the 10-year bond, after we get this counter trend move, if it moves higher again, that could crack the market as well. Now, just a little bit more about the 10-year yield. So this is really interesting. I mean, I sketched this in here. Unfortunately, I don't. I mean, I do have some data going back. I mean, this is stock charts data. It starts right here. I do have some data going back 100 years or so, but I don't think it's that accurate, so I omitted it from this study. But I kind of sketched in here roughly. We had this peak in 1920, around 5.5% on the 10-year, and or it might have been a tad bit higher, maybe 5.6, but this is around 5.5% for the 10-year. And we can see this is a real important long-term pivot point. And we can see here in the mid to late 60s, I mean, this was, rally here in 66, pullback, breakout, retest, big move, big correction here. The counter trend move in bonds bottomed here. Then it turned up again. And we can see here getting to the mid to late 90s that 5.5, this was a key level, early 2000s and right before the GFC. And so the 10-year rallied, it peaked at 5%. It's come down. But we'll see. I mean, we're likely to get a counter trend move with a recession, but the question is, do we get, I mean, is the recession going to take, some time? Is it going to take another 6 or 9 months and maybe you get you get a move higher again before the recession? So that could be recessionary in itself. I mean, looking at the history here of this line and considering all the debt we have, when we see the 10-year go above 5.5%, I mean, when you're seeing it at 5.7, 5.9, 6%, that's probably the point we're going to have to do yield curve control, and that the market will really struggle at that point. And the market and the economy cannot handle long-term interest rates at that high of a level. And so here we can see how, the total return really, in secular terms, you could say there were these two. I mean, this is when was that? 1968 or so, and then you had this peak, I think, in 66, when the total return really slowed down and fizzled out. And of course, that coincides with this move here from 4 to above 5, 5.5. So just illustrating what happens to the total return in the 10-year and in bonds, when we have rates moving, or bond yields, I should say, significantly higher. So that's where we are. Quick video. I mean, nothing groundbreaking or entirely new in this video, but just want to point out that we're setting up over the coming years. It's kind of a domino impact where the bond market breaks, then the stock market breaks, then you're going to see the dollar break. And we've already seen the first leg of that happen. And so eventually when we get to the second leg, that should coincide around the time with gold making that huge breakout and precious metals starting that new secular bull market. I know I've been saying that for a couple years, but it's getting closer. We're getting closer and closer to that. And we'll continue to monitor it over the weeks and months ahead until we get to that point. Let me know what you think in the comments. Thank you so much for tuning in. Talk to you guys again in the next video.